Takes us to our talk of the tape and what tomorrow's speech from the Fed chair may bring for investors and stocks. Here to help us answer that is Ellen Zentner of Morgan Stanley Wealth Management. It is great to have you, Ellen. Welcome back.
Thanks, Carl. It's good to see you again.
I remember you because I went back and looked. It was May 23rd when your team at the time wrote a piece that said weaker prints are coming. And you looked at core PCE, you were looking at insurance, you were looking at rent, and all of it really has come to pass.
Yeah, it really has. I think, part of that bottoms-up approach to inflation forecasting is really what's necessary in this environment. And I think one of the critical benefits to being at a large firm like Morgan Stanley and being on the research side of institutional securities is that Diego Anzoátegui on that team, who is our inflation guru, is able to sit down with all the equity analysts around the sectors and work with them individually on what they're seeing in their sectors and what they're expecting, and then understanding how the BLS calculates all of those things. And so, that the Fed call for that team has been fantastic. That the Fed would start cutting in September and go steadily through the middle of next year because the inflation forecasts have been spot on.
At this point, is your argument that risk assets are still too benign relative to the odds of a recession?
Well, I think they are, which might sound odd to say because I'm a big believer of the soft landing. We've had that soft landing call at Morgan Stanley since March of 2022. Can you believe it? That's a long-standing call. It's very difficult to keep a call for that long. But at the same time, there is a slowing of the economy, a slowing of the labor market, a slowing of inflation, and the Fed has to get this right. And so I look at something like equities that seem to be pricing next to zero chance of recession. I look at corporate credit that certainly doesn't seem like spreads are pricing in a real big chance of or as big of a chance of recession as it probably should, just to be realistic. So while I'm a firm believer in the soft landing call, I think risk assets are probably a bit too benign.
Even some of your peers on the street took their recession odds up a little bit after, say, the July jobs number. Then they brought them back in once we got retail sales and claims.
Well, I think it's a little bit ridiculous to move recession probabilities around like that, so high frequency. Recession probabilities are always fraught with issues, right? And a lot of the recession probability models themselves have a difficult time discerning the difference between a kink in growth or, say, a shift in regime, meaning from very strong growth to slower growth, versus strong growth to recession, right? And it will misinterpret. And so sometimes these models will misinterpret. And so making minute changes really to recession probabilities, I'm not sure that that's really helpful to investors.
Lately, you're writing about maybe reaching a terminal rate earlier than you had previously thought. What's your thinking on that?
Well, I think when we think about the risks to the Fed cutting steadily all the way through the middle of next year, what are the odds that all of that goes perfectly, right? And so basically you would be saying, the risk for downside from here is greater than the risk to upside. And look, I think Powell has shown that he can be nimble around the incoming data. I think he would point to 2019 as a prime example of when the data was deteriorating. They were concerned about a global recession approaching. They moved to the sidelines and started cutting, sort of that quick course correction, sort of 94, 95, right? Recognizing that you could do some quick actions here and keep the economy going. And so I would think that now that you don't have to worry about inflation, you can focus on the labor market. Some of that quick course correction means that some of that cutting could be front loaded.